Good afternoon, everyone, and welcome to Castrol's India Q1 2018 results conference call. Today, we have the management represented by Mr. Omar Dorman, Managing Director, and Ms. Rashmi Joshi, Chief Financial Officer and Whole-Time Director at Castrol India. Before we start, I would like to mention that a few of the statements that we make today may be forward-looking in nature. At this point of time, I would request Mr. Dorman to make his opening remarks. Thank you, and over to you.
Thank you, Raghavendra. Good afternoon, everyone, and welcome to, once again, our quarterly call, and thank you for taking the time to join this call. I'll just say a few words, and I'll then pass it on to Rashmi, and then hopefully allow time for questions, because I'm sure there'll be questions. So first of all, we're really pleased to announce a strong set of results once again in quarter one. If you look at the results, we've posted on a like-for-like basis 5% growth in the bottom line, driven by volume growth. And that actually makes us, if you look at the last 9 quarters, we've grown in 8, apart from the one quarter, which was the quarter 2 2018. So 2017. So that makes Castrol growing successively and consecutively for 9 quarters. And I'm really pleased about the Q1 results. As I said, underlying performance is 5%. In an environment where we've seen 3% input cost increase versus quarter 4, where we also have to take a price increase, and our premium positions have increased. So in an environment like that, to see our volumes coming strongly, especially after a strong quarter 4, is extremely pleasing. And the good thing is, beside our focus on personal mobility segment, we also have increased focus in broadening our participation in select mass market segments. And in quarter 1, we've seen the results of that, where we've seen our commercial volumes delivering growth. On top of that, we also continuously innovate to deliver differentiated future-ready products. So Q1 saw a number of new product introductions. Namely, we introduced Castrol Magnatec with dual-lock technology, which is in the passenger car market. We've introduced Castrol CR-V Turbomax with Dual Shield boosters. And we also refreshed the specialty portfolio with Castrol Transmax driveline oils, and as well as our grease portfolio with Castrol Spirol. So these are all initiatives that we launched into the market with differentiated technology. One exciting news is that we have a product which is actually Castrol Breakout, which is also sold in India, will play a critical role in NASA's mission to Mars, proposed to launch early morning tomorrow. And we will be providing lubrication to a range of instruments on the inside lander. So that's really exciting, and we'll be watching with great interest tomorrow morning. Again, in quarter 1, we continued investment in our brand building, and I mentioned that we had new product introduction into the market, and this is the first year ever that we're going to have 3 of our main products on TV and receiving investment for brand building. We are ahead in terms of share of voice in the marketplace, and that's something that we will continue to do. And one other pleasing news that we also have is that we've been, as you know, we've been driving expansion and distribution reach, and also focusing on getting new accounts. And we've been awarded by Ford their first fill for a 3-year period, which means that all local and export vehicles produced in India will be filled with Castrol engine oils and transmission fluids. And with that, we also are really pleased that Silvassa plant, our Castrol India Silvassa plant, has become the first ever lubricant plant in India to win the prestigious Ford Q1 quality certification, which is an endorsement of the quality processes and quality of our products by a respectable and very prestigious certification. So lots of activities in Q1, and once again, I am personally really pleased with the performance in Q1, building on the momentum of second half of 2017, and we're really optimistic about the rest of the year in terms of our continued growth. With that, I'd like to pass on to Rashmi to also share her thoughts.
Thank you, Omar, and thanks everyone for joining the call. I think in subsequent to what Omar has said, a very good performance on margins, profit as well as volumes, and consistent performance despite cost of goods increases. I think we continue to also focus on robust cost management and working capital management. As you would have seen from the numbers, our cost increase year on year, or the same period last quarter, is only 5%, and this is after taking into account the salary increases that we have to give every year. You will see that the employee costs are less than last year, and that is due to some continuous improvement initiatives we undertake as part of our efficiency measures. Similarly, working capital continues to be managed in a robust way, whereas debtor days are below 21, and our inventory days are also lower than last year. I think that's all I have to say for now, and we are happy to answer any questions that you may have. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashwarya Deepak from Reliance Mutual Fund. Please go ahead.
Thank you very much. Sir, can you just help us in terms of volume growth coming from the CV and the personal mobility segment individually in this quarter?
Yeah, so they are both single digits in terms of growth, and as you remember, CVO has been flat for a long time. So if I look at the personal mobility and CVO, they're both single digits.
Is it a higher single digit, lower single digit? Is there any decline in the industrial segment?
Industrial segment is under pressure. We've seen a decline in industrial volumes, especially the wind sector. With the wind industry has been under pressure since the last quarter, fourth quarter of 2017, and we have a big play in that. And so we've seen some volume drop in industrial, and also we've lost some of the tail end, which is the low margin area. But apart from that, both automotive spaces, personal mobility and CVO, have been respectable single digits. Let me put it this way.
Sure. And sir, next is how you, since the quarter ended and already 1 month has passed, so how you are seeing the traction, especially in the CV segment now? Is there any improvement in this particular segment? The growths are picking up. And the second is, in the press release suggests that there are some broadening in the participation in the CV segment in the select mass market. It's there in the release. So just want to understand in what context we are talking and how big is this market where we are strengthening the presence.
So this is when we say mass market, this is so we have the new gens as well as the old gens, if you remember, and we play in both markets. And the new gen is where the technology is moving towards, and the old gen is where we still have a respectable size of volume, and that market is been degrowing actually. But now we believe that with all the infrastructure development and infrastructure investment, that market will also continue increasing, and that's why we launched some differentiated products into that market to make sure that we also take advantage of that. So I won't be able to give you a forward-looking statement around April volumes, but what I can say is, we expect the trend from Q1 to continue and CVO market to be positive for the remaining of 2018.
And just in continuation of when you say the mass market products, so are we talking about the launches in the new generation or old generation?
So in the CVO, in both the new gen as well as the old gen. So for example, when we talk about the grease portfolio, that's more to old gen as well as the new gen. So in both our markets, transmission fluids is both again to old and new gen segments, and CRB Turbo Max is to new gen.
Sure. And sir,
so I'm sorry to interrupt, but maybe I request you to come back in queue for follow-up questions. Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Kashyap Zaveri from Emkay Global Financial Services. Please go ahead.
Yeah, thank you very much for the opportunity. I have two questions. One, I understand that we had taken some price increases beginning of this quarter, but if I look at our realizations, they seem sort of flat on Y-on-Y basis or even declined on quarter. So is that anything to do with the GST adjustment, or are there trade discounts which have gone up which probably led to this? And question 2 is that in terms of base oil prices, what's been the movement on Q-on-Q as well as Y-on-Y basis?
Sorry, can you repeat the second question?
In terms of raw material, what's been the increase on Y-on-Y as well as Q-on-Q basis?
Okay, so let me take the first question. So you're right, because of GST, our net realizations were lower than previous year. But if you look at like-for-like numbers, it is 5% higher than last year, same quarter. Yeah. In terms of cost of goods increase versus last year, we have an increase of about versus last quarter, we have increased about 3% in the cost of goods, and versus last year, it's $120, which was the base oil change, which has that much increase we have seen.
On Q-on-Q basis, why would realizations be lower actually? On Y-on-Y, I can understand, but it looks like Q-on-Q also they have gone down.
Q-on-Q means, you mean to say?
Versus Q4 of CY17.
Okay. So we had to make certain interventions because we, as you know, we lead in price increases, as Umar also mentioned at the beginning. And then to maintain volumes, we have to do some kind of trade inputs to make sure that the volume doesn't take a hit. So we did that selectively on certain brands. And as a result, you would see that, the net sales value has not been as high as the price increases that we put in.
Okay. And are those interventions still there, or they have been sort of taken?
So I'm not sure, but I think if I look at the net sales value versus Q4, it is up.
There's a 2 rupees increase.
Yeah, there is an increase. So I'm not sure because I'm not sure which number you're looking at, but the numbers that we have is actually COGS have gone up, and we have recovered COGS in terms of our NSV improvement. So there is an improvement in NSV, but of course you're looking at top headline, and there are product mix movements which also have an impact. So although we have taken a price increase in the range of 2 to 4% in the quarter, and depending on the timing of course, for the price to be effective in the marketplace, because it wasn't from 1st Jan to 31st of March fully effective.
Okay.
You need to look at product mix, and you need to look at the effect of the price increase, effective date of the price increase. But if I look at even on the average level, we've shown an improvement.
Okay, sure. Thank you very much.
Thank you. The next question is from the line of Aditya Makharia from Motilal Oswal. Please go ahead.
Yeah, hi sir. Just a question is, what kind of volume growth are you looking at next year? That's one. And second is, post GST, we heard that the trucks now are running more because, the efficiency in transportation. So does that benefit your volumes in any way?
So when you say the next year volume, you're talking about probably 2018 volume increase, and we won't give you a forward-looking statement. But what I can say is we will grow ahead of the market, and we expect the market to grow between 4 to 5% this year, and we will grow ahead of the market. In terms of GST, yes, I think the freight movement, we see a positive uptick in the freight movement, and that's also in the infrastructure development. That's why we see an increase in the commercial segment, and that looks like it's sustainable throughout the year. And you've seen the vehicle sales, the commercial vehicle sales, they're quite positive.
Yeah, which is why I was maybe expecting that your volumes could surprise at least for this year, because you're seeing a lot more on-ground movement.
Yeah, but the commercial vehicle sales is positive for the future. I mean, it doesn't impact us directly in the first quarter. So there's a lag because for the first time they go to service, they start moving, and they go to retail. So it's a pipeline, but it's a really positive signal for the mood of the market.
Okay, got it.
Thank you. The next question is from the line of Karthik Swaminathan from Catamaran. Please go ahead.
Good afternoon, sir. Thank you for taking my questions. My first question is on the comparative growth in both the old gen and new gen CVO. So how much faster in these segments are we growing versus the market? And similarly, even in the personal mobility segment, how much faster are we growing versus the market?
So let me tell you, I can give you the total share. Our share is flat versus last quarter, which means that we've grown in line with the market. Now, within that, there may be some changes, but you can't look at it on a month-to-month basis, but if you look at it on a quarter basis, the good thing is we've grown with the market, despite the premium that we have at the moment.
Okay. And my next question is that what prevents us from, I mean, we've been growing slightly ahead of the market for some time, but our market share more or less has remained in a similar range. So what prevents us from growing, let's say, 8 to 10% volume growth when the market is growing at 4 to 5%? We are still not the largest. I mean, we're not more than half the market, right?
So we're 1/5 of the retail market.
Yeah.
And the important thing is to have a profitable growth. We're not chasing volume growth for the sake of volume growth. It needs to be profitable volume growth. And that's why when there's an input cost increase, we take action through price interventions, cost efficiencies to ensure that we remain profitable, but at the same time balance it with volume growth. So that's why it's easy to grow volume, but at the expense of profit.
Yeah, I think to your question of why can't we grow at 8 to 10%, first of all, lubricants market average will go at 4 to 5%.
Yeah.
And you'll have to cede a lot of profit to get to 8 to 10%. And I don't know whether that's a wise strategy. Okay.
And we're the largest player in the retail market.
Yeah.
So we're not a startup where we can, grow 2 times, 3 times the market size. We have scale, and we're the largest player in the market across all the categories.
Got it. Thank you for answering my questions.
Thank you. The next question is from the line of Kunal Bhatia from Dalal & Broacha. Please go ahead.
Yes, sir. Thank you so much for the opportunity. This was a question. Ma'am, I just missed out on the number of the base oil price you mentioned this year vis-a-vis last year, which we have.
So we are $120 higher than last year.
$120 higher. Okay. And also, ma'am, if you could share the volume number this quarter, how much volumes we did?
51.5.
51.5. Okay. And finally, a question in regards to we've mentioning a lot about the premium category. So as of now, on the overall basis, what would be the contribution of premium, if you would give it in terms of passenger vehicle and the CVO?
So we look at something called power brands to total, and that contribution is more than 50%, and it's improving.
Okay. And within the power brands, do you categorize into the higher premium segment as such?
No, all power brands are premium.
But we have also synthetics. Synthetics is something that we look at, and the contribution is still small, but it's increasing, which is good. We have about single digits, respectable single digits in terms of their contribution, and of course higher contributions in terms of gross profit.
Okay, fine, sir. Thank you so much.
Thank you. The next question is from the line of Nidhi Doshi from Daulat Capital. Please go ahead.
Good afternoon, sir. I just had one question. In the automotive segment, what is the volume percentage which comes from the engine oils?
I'll come back to that. Let us just work it out.
Okay, sir. Thank you. I just had this question.
Sorry. Okay. It's not really available. Just give us 2 minutes and I'll answer that.
Yeah, sure, sir. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time.
No, why don't we go with the next question? We'll come back to that.
Sure, sir.
Response. Is that right?
Is from the line of Nitin Tiwari from Antique Stock Broking. Please go ahead.
Hi, good afternoon. Thanks for taking my question. Just wanted to understand that in the previous quarter, we had a growth of about 15% in volumes on a YOY basis, and that contracted to about just 2.5% in this quarter on a YOY basis. So how do we understand the growth in this quarter versus the last quarter? What was the reason for a very strong growth in the last quarter, and why it declined sharply in this quarter?
So if you look at you're talking about fourth quarter growth, right?
Yeah, the December quarter and now.
Yeah, so if you compare December quarter with the previous year December quarter, then that had impact of demonetization. Yeah. So as a result, you saw the percentage increase was high. And of course, there was momentum in all the volumes. And post GST, I think there was good momentum in the fourth quarter, which you see. We have, if you see the total volume now compared to last year 1Q, we've still done better than last year 1Q. And 2016 first quarter also was a big quarter compared to the previous year. So we are consistently growing volumes for 9 quarters now, except for the GST quarter. Okay, so and considering the fact that we have taken price increases before competition, usually there is pressure on volume in the short term. Okay, so if at all going forward, it should be better than this.
Why I ask that is because your growth was actually stronger than the industry growth in the December quarter. But when we look at the March quarter, the industry has grown at about 5% and you've grown at about 2.5%. So
we've grown 5%. Underlying basis, we've grown 5%. That's what I was saying. Underlying basis, we've grown 5%.
So that's on the revenue side. I'm talking only on the volume side of the
No, I'm talking about volume side.
Yeah.
Underlying basis, 5% growth. Like-for-like basis. There was a one-off in quarter one last year. So that's why, and that was in B2B. And if you look at the industry growth, which is comparable, it's 5%.
So there was a one-off volume in the previous year's March quarter, which has, which if we remove that, then we have a 5% growth on our like-to-like.
Yeah, that's what I'm saying.
That's, all right, okay, that's. And then if you could just help me, in terms of one ad expense as a percentage, how much was that, and a breakup of segments, in terms of volume, that how much is two-wheelers, how much is cars, and then CVO and industrial, a broad segmentation over there.
Of volume breakdown, you mean?
Yeah.
So CVO is about 43%, industrial is about 14%, and personal mobility is 43%.
Right. And ad expense?
So ad expense as a percentage of sales for 3% in this quarter.
Sorry, how much?
3%.
3%.
And 20% up versus last year.
Yeah.
Sure. Thank you so much.
Thank you. The next question is from the line of Tarun Lakhotia from Kotak Securities. Please go ahead.
Thanks for taking my question. I have a couple of them. First, just deliberating a bit more on the profitable growth which you have, historically talked about. Do you see there is an opportunity for you to enter, maybe the mid-market segment where margins may be at, say, 15 to 20% as compared to the current 30% which you earn, but it may still qualify as a profitable growth, maybe earnings and ROE accretive as well, and help you probably, grow volumes at 8 to 10% as compared to low single digits currently?
So actually, your definition of middle size, what you said, middle market, is our definition of mass market opportunity. So that's what we were talking about. And it's about having a balanced portfolio. We do play in market spaces. We also play in different market segments. And, then actually the profitability is, as you said, rightly said, lower, but that's why you need to balance it with your power brands and make sure that overall the growth is profitable. So that's part of our strategy. We focus on the top end as well as the mass market. But it's about creating that differentiation so that we can continue enjoying the premium positioning of Castrol brand in wherever we play. So we won't go into a really low end of the market where we feel that there won't be any appreciation for the premium technology that we bring. And again, when, for example, we play into, last year we launched a product into the agri segment, which is mass market opportunity, but with a 400-hour protection guarantee or promise. So that's the differentiation that we'd like to create.
Understood. So, to put it other way around, you're saying essentially the profitable growth which you are targeting would require you to earn that 25-30% kind of EBITDA margins on a cumulative basis. Of course, there could be products across the range, but as a company, that is the intention.
Absolutely. So maintain the earning ratio, but you can do it through a balanced portfolio. And because one thing that we know that the growth, if you want to sustain the growth in the business, we need to have volume growth. You can't, by maximizing unit profitability, continue growing it. So that's why it's a balanced approach and balanced portfolio.
Understood, fair.
Tarun, I'm sorry to interrupt, but may we request you to come back in queue for a follow-up question? Thank you. The next question is from the line of Viral Shah from Enam Holdings. Please go ahead.
Yes, thank you for the opportunity, sir. So my first question was on basically the CV side. What would be the industry growth during the quarter?
So industrial growth?
Yeah.
No, that's what I said. Industrial was, this was a decline, not a growth.
And would the industrial portfolio for you, excluding wind, also have declined?
There was some low end of the spectrum products that we walked away from, and that would be even without the wind, there would be a slight decline. Yes.
Sure. So second, on the commercial vehicle side, you said you would have grown in single digits. What would the industry as a whole during the quarter have grown?
Industry?
No, the industry. Okay, just one. Growth of the segment is also single digits. Yeah.
So you do not think that we've lost market share here then?
No, that's why I said we maintain the market share versus vis-a-vis Qtr4.
Okay. Sir, can I get the breakup in terms of OEM and replacement in commercial and passenger?
So OEM, you mean first fill or channel?
So direct to the OEM and the distribution part, what would be the mix?
I think OEM first fill is a very small part of our business, and we do engage in first fill when we see an opportunity to leverage that investment in the retail market or in the channel. So that's why first fill is a small portion of that. And then we play in the franchise workshop channel. But as we always say, our big play is in the retail, where we can leverage our brand and brand pool, and as well as our distribution expansion. So really the franchise workshop business will be less than 10% in the total volume. But it's an enabler rather than a means to an end.
Sure. And on the commercial side, commercial vehicle side, how much would be direct supplies to OEMs, sir?
Commercial, again, it's similar, less than 10%, maybe 7-8% of the commercial portfolio will be into OEMs.
Thank you. The next question is from the line of Abdul Sabnis from CIMB. Please go ahead.
Yeah, this is following up on Omar's comment about last year's numbers having some one-off. So if I take what you mentioned, that actually on a like-to-like basis, it's a 5% growth. That would imply that last year first quarter volumes were 49 as against reported 50.2 to compare on a like-to-like basis. So I'm trying to understand, A, what is the nature of the one-off you're talking about here? Because I think when we had similar call last year for first quarter, there was no mention of any one-off.
Okay, thank you. But, we don't specifically talk about one-off because these are opportunities that we chase. Last year we had it, and this year we didn't have it. And, we can still, have an opportunity to supply a big customer. But what I talk about is, the fundamental business is where we focus on, which is the retail business and the power brands and the personal mobility. The focus is we don't focus on total volume. We focus on where we invest, whether we're growing. The discussion is usually about our investor and analysts are asking too much questions about volume, and they're hooked on volume, and they just look at the total volume and see it as an indication. But, there are always businesses that we supply to fleets, to industry, which is, on a one-year deal basis. I don't know why we should, talk about it each time. I couldn't understand the comment.
Thank you. The next question is from the line of Shan from Edelweiss. Please go ahead.
Thank you for the opportunity. This is Shata. So just one question, taking it forward from the previous ones. As you said, we have grown in line with the market this quarter in terms of volumes. However, for the full year, we are looking at growing ahead of the market. What is it going to be changing in the next 3 quarters that should lead us with the volume growth ahead of the market?
So we believe that the first quarter, because of the price increase, and the premium that we established because of the price increase, we didn't see the full volume. And now I think the market, our expectation is the market will catch up, and we'll see that Castrol volume will start picking up as well. We believe that in the second half, we were ahead of the market, and we shared that with you in the last quarter. And we believe that we will go back to that momentum. And that's why we're pleased with the performance. And that's why I talked about the underlying basis, because I don't usually talk about that. But the underlying basis is important to give you a signal that, where we focus, despite the price increase, we are still showing growth in line with the market, which is, I think, it's a healthy signal.
Fair enough. Thank you. All the best.
Thank you. The next question is from the line of Basant Patil from HDFC Securities. Please go ahead.
Can I just answer that question before that? There was a question on how much of the passenger car oils, of the total, how much is engine oil? And it's about 72% of our total volume is engine oils.
Thank you. We have the next question from Basant Patil from HDFC Securities. Please go ahead.
Thank you, sir, for taking my question. Just wanted to understand.
Basant, your line is unmuted. Please proceed with your questions.
Can you hear me?
As there's no response, the next question is from the line of Prayesh Jain from IIFL Wealth. Please go ahead.
Yeah, good afternoon, sir. Sir, one question on the engine oil contribution. Because it contributes 72% of the volumes, how do you see this over the, when electrification happens in a big manner, how do you see these volumes getting impacted for Castrol, and how do you see yourself protecting this business?
So, in terms of electric vehicles, you may have joined the call previously. We say that our expectation for the next 15 years, the internal combustion engines will continue increasing, and we expect actually globally for the vehicle park to double in the next 15 years, mainly driven by the internal combustion engines. Now, the rate of increase of the electric vehicles will be faster, and the latest estimate that I received from our BP is that it's going to be 6% of the total vehicle park by 2035, which means that there's still a lot of room for growth for internal combustion engines. Now, having said that, of course, if the purpose of the electric vehicles is to reduce the emissions, there's a lot that we can do in the meantime to support that low carbon world, which is part of our strategy. And we are introducing products, and we're working with different OEM partners to also play into the low carbon environment. And one interesting fact that I read about is that actually Castrol formulation 10 years ago, if you compare the changes in the formulation, we reduced, in the last 10 years globally, we reduced 5 million tons of carbons, which is equal to removing 250,000 cars from the vehicle park. Oh, wow. We can't wait for the electric environment to happen in 15 years. I think there's a lot that we can do in terms of moving to a low carbon, low emission world, and that's what we're doing. And making sure that the cars are more efficient, the fuel is efficient, and the oil drain intervals are increased. So that's something that we do. Now, having said that, we also are testing different startups. We're investing into startup business in terms of advanced mobility and digital to see how Castrol is going to play in the electric world. And by the way, we also have the industrial volume as well as the marine volumes, where for foreseeable future, beyond even to 2035, they will depend on fuel and lubricants for power.
Okay. Sir, and another question was on the commercial vehicles. This again is a medium-term one. The fact is that there is a lot of focus on reducing the kind of overloading that these truckers have been doing, and secondly, with the GST implementation, the driving time has reduced, and they're making more rides now. So both these factors putting together, and the third which may come across would be this what do you call the benefits for replacing the older fleet, the scrappage norms. So all these three put together, do you think that what would be the impact on commercial vehicle lubricant demand in the medium term?
So it's a great question. There are many dynamic parts at the moment, and too many variables. One thing which is quite obvious is there's also on top of that there's a regulation change which is moving to BS6 by 2020. So there's also a technology change, there's a regulation change, and the OEMs are forced to invest into the new technology and be ready in the next 2 years. And of course the scrappage will come in. So there are lots of moving parts at the moment. But what we see is, the commercial segment will also change in terms of behaviors as a result, because there will be more fleetization than consumer drivers, consumer drivers. Okay. So that means that we need to ensure that we have products which are ready, and that's something that we're working on. Then we have various projects in play, and also make sure that we have offers which are suitable for fleets, so that we can continue taking advantage of the changes.
Okay. All right. Thank you, sir.
Thank you. In the interest of time, we will be taking 2 more questions. The next question is from the line of Vipul Shah from Sumangal Investments. Please go ahead.
Hi, good afternoon, sir. What was the volume last quarter, December quarter 2017?
50. Just give me 2 seconds to just check. 54.2.
54.2. That is in December quarter. So we have come down to 51.5 from 54.2 in this quarter.
Yeah, but that's the seasonality, and you need to look at quarter 1 versus quarter 1.
Okay, so can you give me first quarter 2017 volume as well?
50.2.
50.2. And last question, what is the absolute base price at which we are doing the contracts right now?
So I didn't understand that.
Contracted rate.
What? So contract?
Base oil prices.
No, we can't disclose that.
Okay, sir. Okay. Thank you very much, and all the best for the future.
Thank you.
Thank you. The next question is from the line of Jai Shriram from Karvi Stock Broking. Please go ahead.
Oh, hello. Thank you for taking my question. This is pretty much related to what we had discussed. You were talking about achieving volume growth, and we have on one side where the lubricant consumption per vehicle is actually going down. So can you tell me how do we go about it? And I have another question which is based on the old gen and new gen. So when you say new gen, does it pertain to all the new commercial vehicles that are being launched in the market? Or is it compatible with the old vehicles as well?
So let me start with the second question. The new gen is all the new trucks being produced and introduced to the market. So that's the new generation oil, which require BS4 minimum requirements for fuels and lubes. And BS6 will also be part of the new gen.
So whatever new gen BS4 compliant, is it also compliant for BS6?
No, it's a different requirement, and it's a different investment required for the OEMs to be ready for BS6. It's low SAPs, which is low sulfur, that we need to produce. And actually, we have the products ready and we have the knowledge and the products ready in different parts of the world. It will require for the OEMs to test and agree on the parts before we can launch it. But we've already started the tests, so we are well within reach of launching those products.
So if you're going to manufacture those products in India, does it require higher capex?
No. Capex is more it's not a capex, it's an investment in technology.
Okay. And these cannot be used in the old trucks which are already, say 5-year-old trucks. You
can use them. You can't use the old gen in new gen.
Okay, got it. Yeah, and my first question?
So can you remind me the first question? I'm sorry.
Okay. It was about how you are going to achieve volume growth when we have long range intervals.
Yeah, so that's what we've been talking about in commercial. Actually we've been seeing that as a pressure. So the commercial lubricant increase is not in line with commercial vehicle sales because the drain intervals are changing and increasing in multiples. So what happens is, of course, the volume growth is part of the freight movement and the activity in the marketplace. So if the trucks are running, that's good for our business. Whereas in bikes and passenger cars, the intervals have been a bit more stable. So the increase in cars and how many cars are on the road has a direct impact on lubricants. So I think we've seen that the car oil intervals have now around 15 to 20,000 kilometers per change, which has been quite stable globally for a long time. Whereas for trucks, it's been now almost pushing up to 100,000 kilometers.
Okay. Can I squeeze in another question?
I'm not the deciding part on that.
Okay.
Sorry to interrupt. Due to time constraints, that was the last question. I would now like to hand the conference over to Mr. Omar Dorman for closing comments.
Thank you, and I'm really sorry that I know that there were other people in line with questions, and I hope that we'll be able to answer those questions in the next call. Thank you very much once again for your interest. And as I said, we are pleased with the Q1 performance. I know that you go into maybe reported lines, and that's why you're trying to understand. And I hope that this call is useful in terms of you understanding what the numbers are saying, what the numbers are really saying. And we believe that we have a really strong business delivering sustainable growth. And we had our AGM yesterday, and we shared our 2017 results with the shareholders. And we're really proud because in the last 17 years, we've been creating 11% wealth growth year on year. And that's way above for any company. I think Castrol has been there for the long run and delivering growth every year, which is something that we're really proud of as management. So once again, thank you, and I hope to catch up with you in the next call, if not before. So have a great day, and thanks for all the arrangements.